Today, I am presenting an analysis of Dalton Investments' shareholder proposals for Ezaki Glico. The central theme here is unlocking potential, the idea that Glico is a world-class company currently trapped by inefficient management and capital structures. Dalton argues that while the company's brands are legendary, the stock has failed to reward investors adequately. This deck serves as a blueprint for institutional reform, aiming to shift Glico from a traditional, conservative management style to a more aggressive, capital-conscious approach. For us in corporate planning, this is a textbook case of how activist pressure is being applied to Japanese blue-chip companies to force a realignment with global capital market standards. The Dalton thesis identifies a stark reality. Despite strong overseas growth, Glico's return on equity, ROE, has collapsed to just 1.8%. To rectify this, Dalton has proposed 4 interlocking mechanisms: board enhancement, capital efficiency, aligned incentives, and TSE compliance. Specifically, they want to add 2 outside directors to explore all strategic options, including the radical step of going private. They are also demanding a 35 billion Japanese yen share buyback, approximately $10 of outstanding shares, to shrink what they call a bloated equity base. This isn't just a list of requests. It's a systemic overhaul designed to force the board to treat capital as a finite resource rather than an endless cushion. This slide highlights the Glico paradox. The company possesses world-class confectionery brands like Pocky and Pretz that have a massive global resonance. These are not just local successes. The overseas business now accounts for more than $50 of the total operating profit. Glico has successfully expanded across competitive markets in the US, China, and the ASEAN region. From a brand equity perspective, Glico is a powerhouse. However, Dalton's point is that this operational success is not translating into shareholder value. The paradox is that a company with such high-margin, profitable global growth should not be struggling with an industry-low ROE. The data here is damning. Over the past 5 years, Glico has vastly underperformed the broader Japanese market. While the Topix Index saw a 141% total shareholder return, TSR, Glico managed only 42%. On an annualized basis, Glico's 7.1% return is less than half of the TOPIX's 18.8%. This divergence indicates a structural disconnect between the company's operational wins and its market valuation. Investors are essentially discounting Glico's future earnings because they lack confidence in the board's ability to manage the balance sheet. For an executive, this slide represents the cost of inaction, the literal loss in market cap compared to simply tracking the index. When compared to its direct domestic rivals, Glico is an industry outlier in the worst way. While competitors like Meiji HD, Morinaga, and Calbee maintain double-digit or high single-digit returns, Glico's 5-year average ROE sits at a meager 4%. Glico's own target ROE of 6 to 8% is criticized by Dalton as being too conservative and failing to meet the 8% cost of capital expected by investors. Furthermore, Glico's latest operating margin of 2.4% is significantly lower than its peers. This slide proves that Glico's issues aren't just industry-wide headwinds like raw material costs. They are internal and structural. Dalton diagnoses the 1.8% ROE as a result of 2 primary factors: portfolio drag and trapped capital. While the confectionery segment is recovering, the health and dairy segments are bleeding cash, with the dairy business suffering substantial operational losses. Simultaneously, Glico is sitting on excessive pure financial assets, including cash and securities, that account for approximately 33% of its total market capitalization. This trapped capital artificially inflates the equity base, which mechanically depresses the ROE calculation. Dalton's argument is simple. By shedding non-core assets and shrinking the equity base through buybacks, Glico can mathematically force its ROE back toward industry standards. To fix these issues, Dalton proposes a 4-point architectural upgrade. First, governance, injecting outside expertise, specifically Dalton's own nominees, to evaluate all strategic options, including non-public alternatives. Second, capital allocation, executing a 10% buyback to right-size the balance sheet. Third, incentives, shifting management compensation away from fixed cash to ROE TSR-linked restricted stock to align their wealth with shareholders. Finally, strategy, amending the Articles of Incorporation to mandate ongoing compliance with Tokyo Stock Exchange, TSE capital cost requirements. This is a holistic attempt to change the very DNA of Glico's corporate governance. This slide contrasts Glico's current plan with Dalton's demands. Glico recently announced a 25 billion Japanese yen buyback, which they believe supports their 6 to 8% ROE target. Dalton argues this is insufficient to restructure the bloated balance sheet. They are demanding a 35 billion Japanese yen buyback, 10% of shares, as a mathematical necessity to rapidly shrink the denominator and drive ROE toward the 10 to 12% range. Dalton emphasizes that this is fully funded by the existing excess cash Glico is hoarding. It's a direct challenge to the board's gradualist approach to capital management. Dalton identifies a severe misalignment of interests in the current compensation structure. Directors currently receive heavy fixed compensation, totaling 192 million Japanese yen in FY 12/24, with virtually zero stock-based incentives. President Ezaki himself holds only 0.1% of the company. Dalton's proposal is a restricted stock flywheel, redesigning pay into an ROE and TSR-linked system. If management is incentivized to boost these metrics, corporate value and stock prices rise, benefiting both shareholders and management's own wealth. The goal is to make the board think like owners, rather than salaried employees. The final slide presents a clear choice for shareholders: Glico's gradualism versus Dalton's structural transformation. Glico offers a modest 6 to 8% ROE target and a 25 billion Japanese yen buyback. Dalton demands a 12% ROE target, the industry standard, and a 35 billion Japanese yen buyback. Most importantly, Dalton wants to mandate capital cost awareness via the company's charter and outside board reviews. For an institutional investor, the question is whether to trust the incumbent management's slow and steady path or to support a radical catalyst to unlock what Dalton sees as significant trapped value.